If you form an entity, you need to get a tax ID number, an EIN, employee identification number, or employer identification number. You can file that through your CPA, get one through the IRS, and this will be the tax document that you need to go to a bank to open up a separate bank account for your business, because you don't want to commingle funds. You could do a lot of Google search on that and hear all the horror stories, but you don't want to do that. Hey, what's up, all of my real estate peeps? This is Brian Lucier with another episode of the Why Not Real Estate Podcast, Golden Nugget. And in the Golden Nuggets, we'll take a tip, tactic, or technique, and we'll unpack it at 30,000 feet that you can use for your own reference, for your own business, for your own ideas on how to be a successful real estate entrepreneur. So today, the question is, do I need an LLC? That's a good question. Well, the short answer is it depends. You may need an LLC depending on what you're planning to do, but we'll unpack that a little bit later. So if you're asking that question, the assumption is that you're probably going to be running a business. So if you're watching this video on my podcast, you're probably thinking about investing in real estate. Those are two assumptions I'm going to go with as we unpack this. So let's say today you're still a W-2 employee. You can own your own business and reap the benefits and tax savings of being a business owner. So why open a business? Because you can reap the tax savings and the extended benefits that you can offer yourself as an employee. All really good stuff. So I'm going to briefly tell you a little bit about my structure. But again, let me preface all this. I am not an attorney. I am not a CPA. I am not giving you legal advice. And you absolutely should seek out professional advice on any of the information that you get on our educational videos or any other website as well. You should be vetting all that information. So here's my structure. I basically have three different entities. One owns everything. Let that sink in. That's my holding company. That's how I buy the assets. The second one does everything. This is my management company. So they don't own anything for assets and have no value, but they hold all the liability because they are doing the actions on the day-to-day. And then the third company is a ghost. Everybody says, what do you mean it's a ghost? This is the financing company, okay? So my reserves will go in the finance company. It will loan to the holding company. The holding company will buy the asset, and then it'll give it to the management company to take care of the day-to-day stuff. As the management company increases equity, eventually we'll cash out and write a loan through the holding company back to the financing company. So we've buffered our liability away from tax creditors or lawsuits or anything like that. Now, I can't tell you more than that, or I would pierce the whole reason for having those entities. So let's dig in a little bit deeper. Why would you want to own your own business? And let's assume right now that you're watching this video and you want to get started, you want to start buying real estate, you don't even know where to start. The first thing I would probably consider is opening a business, and we'll talk about the structures on that, so you can start to deduct the expenses, and we'll talk about that as well. So I love to use this example because I always baffle people. They say, well, it costs what it costs. But the question is, how much does a $1,000 computer cost you as a W-2 wage earner? Okay, everybody's going to walk into the store, see the price tag, and say, well, it cost me $1,000. But does it cost you $1,000? So just when you buy it, in Massachusetts, the sales tax is 0.0625. So you've got $62.50 there. The employment tax for you to earn $1,000, probably roughly guesstimated around 30%. So it may cost you anywhere $300 in taxes to earn $1,000. And if you figure state and federal taxes, my rough number is $450. So that $1,000 computer that you're going to buy out of pocket without a business is going to cost you $1,512.50. That's a 50% markup on your cost. That's crazy to pay that. Or if you ran it as a business, and let's say you earn $20,000, I mean, hopefully you won't earn more than that, but I'm using it as an example. If you earn $20,000 and you bought a $1,000 computer, now you were deducting $1,000 off of your taxable income. So now you only will be taxed on $19,000 in our example. But wait, it gets better. So maybe you can't run out and do office space or pay rent. That's fine, because you can do a home-based business. And the IRS has a red flag threshold of around 20%. So if I'm going to run my business from my home, I could look at all of my home business expenses, and as long as I don't cross that 30% threshold, and again, I'm not a CPA, I'm not giving you legal advice, check with a legal professional. But if it cost you $20,000 and you could take 20% of that, you're taking $4,000 off of your taxable income. That's wonderful. So now you've reduced your taxable income to $15,000. So how does that all work? If you're running a home-based business, close to that 20% of your living expenses right off the top of your taxable income, this can include your rent or mortgage, your taxes, insurance, your water bill, your phone, the phone service, 20%. You may actually be able to deduct the whole phone. Your intention is your intention. A percentage of your electric, your cable, your internet, your house maintenance, and the list goes on and on to include repairs and maintenance at the property. So that's pretty significant, because if you're going to have clients come and meet you there, the place has got to look nice, you've got to have a refrigerator, you've got to have a bathroom, all that normal stuff. You've got to have insurance, because you don't want someone tripping over your threshold and suing you. That could be bad. So just by the intent of having a business, you can automatically start to take deductions away from your net income to reduce your tax basis. Not bad. So let's say and imagine that we're getting that 20% of a write-off. What else can you do? Well, any tax-based software will have a chart of accounts. And even if you go on to the IRS site, you can get a chart of accounts. I happen to know from my CPA that QuickBooks has in order the same chart of accounts that the IRS uses on their forms. So it's very easy to just transfer the data in when you do your taxes. What a great idea. But you could grab any tax book from Staples or Barnes & Nobles or anything like that. You could go online, you could Google a search. What are the chart of accounts for real estate? What are the chart of accounts for a nail salon? What are the chart of accounts for a restaurant? Whatever it is, but I'm going to stick to real estate here. You can set up your chart of accounts, and anything that you're doing there, training, seminars, books, webinars, whatever it is, subscriptions, you can all start to now write that off as an 100% expense from your net income, reducing your tax basis. Now again, I'm not an attorney, CPA, I don't play one on TV, this is not legal tax advice. Please consult a professional. A great start is to get referrals from other real estate investors or whatever you're going to invest in or whatever your business is. Talk to like-minded industry leaders in your realm and ask them, hey, who's the CPA you use, or who's the lawyer you use to set up your entities, and get referrals. And if you find someone who's been doing this a long time, you're probably going to get a better referral than someone started a couple of years ago. I mean, you may get a great referral, but you'll find that the people who've been doing this a long time know what to look out for, and they're working with professionals that are savvy and are going to understand what it is that they're trying to do. So, to buy real estate. When you put in your purchase and sale agreement, your intent to offer, your letter of intent, whatever it is, my name's Brian Lucier. So when I put in that purchase order, I'm going to put buyer where it says buyer, and I'm going to put Brian Lucier or assignee. Those two words are critical. If you get nothing else out of this golden nugget, get those two words. And when you put together an offer to purchase, it's your name or assignee. Or if you're using the name of your holding company or your finance company or any other entity you have, you can put that or assignee. Now, why is this so important? Because when you get to the closing table, say you're a savvy investor and you have multiple properties, you may have a strategy of putting so much equity or net worth into an LLC. So you may have $1 million cap on an LLC. And then as soon as you start to buy more properties that are going to exceed that $1 million cap or whatever your risk comfort is, you open up a new LLC and start to put those properties or assets into that box. So the question would come up at the closing table. So wait a minute, you were gonna buy this as Blue Penguin LLC, and now I see that you're buying it as Red Turtle LLC. And it said, well, on the contract, I said Blue Turtle or assignee. For this property, for this closing, we're going to assign it to this entity. And here it is, it says or assignee. So there should be no legal issue with that. At the closing table, if you're introducing the LLC you want to hold the asset in. LLCs. Okay, now some of the different entity structures, and again, I'm not an expert on this, so I would definitely seek out professionals, but you have your sole proprietorship. Now, I'm going to go through a list of 6 of these. Please note that each business entity that I'm going to mention here has its different legal, tax, liability, and operational implications that you need to pay attention and adhere to. So it's important you choose the one that's best, that fits the needs for the goals of the business or the asset that you're going to purchase. You may be buying a single-family house, a small apartment building, a syndication, whatever it is. Pick the right entity that's going to be the best for that property or that business. Okay. So again, I mentioned sole proprietorship. This is any person buying it and operating it in their own name. Risky, okay? Because now anything else I own that's in my name, if there's a lawsuit, can now be attached or gone after at that level, okay? So sole proprietor is risky, and I would do some research before I did that, okay? A partnership could be a general partner, a limited partner, or a limited liability partner. And each one of these, again, have their own tax implications, legal, liability, protection of who's in that company. And I've spent tens of thousands of dollars sitting in webinars and seminars and traveling different states all over the place to get information on how to do this properly. And I'm not qualified and I'm not an attorney, so I can't give you that legal advice, but I can absolutely tell you to do your due diligence and find out which of these entities will work best for you. The next in my list is an LLC, a limited liability company, which is treated like a corporation. Now, a corporation is the next one that you can treat as an S Corp, which is a small corp, or a C Corp. And the difference there is really tax implications. How are you being taxed? At a corporate level, it's through the business. At an S Corp, it's a flow-through entity, which could show up on your individual tax return. Then you have a nonprofit organization. If you get to the point where you can give back in this world, fantastic. Open up a nonprofit. I actually know investors that have gone this route, and they'll have something like for wounded warriors or single mothers, or like Our Father's House, which helps unwed mothers. There might be some type of nonprofit that you could actually buy real estate through used specifically for the purpose of that foundation or that nonprofit organization. So that's something else to look at. And then co-ops, that's out there on the table as well. A cooperative, how do you do all that? And how do you make all that work? So if that has not confused you enough, I want to thank you for sitting through this far on this video. You can always bookmark this, come back. We would love it if you would click like, subscribe, and come back and see more of these videos. Tell your friends about these videos. And we just put this out there for free to try to help other people get to where we've been able to get in our journey as real estate investors. So again, do I need an LLC? Maybe. Definitely open up your own business. If you're going to do a home business, you could do that as a sole proprietorship to get started. That's fine. As long as you get your own tax ID. Oh, that's very important. I should have mentioned that. If you form an entity, you need to get a tax ID number, an EIN, employee identification number, or employer identification number. You can file that through your CPA, get one through the IRS. And this will be the tax document that you need to go to a bank to open up a separate bank account for your business, because you don't want to commingle funds. You could do a lot of Google search on that and hear all the horror stories, but you don't want to do that. So keep things separate. If you're running your own separate business to get started, even if it's, I haven't bought a property yet, but I'm thinking I want to do this for real, then do it for real and treat it as a business and not a hobby from the first get-go. I think that's a pretty good primer on do I need an LLC? Thank you for watching. All my real estate peeps, ladies and gents, this is Brian Lucier from the Why Not Real Estate Podcast Golden Nugget, signing off, and we'll see you on the next one.